Hello everyone, thanks for checking out my video. I'm back. While I was away, the US stock market hit yet another all-time high. In case you're not aware, just this year alone, the S&P 500 has hit record high for 53 times. Not just that, the index is also on track for 2 consecutive years of more than 20% gains for the first time since 1998. As for the month of November, S&P 500 has the best gains since 2013. With a traditionally strong December coming up, will the stock market continue to push higher? Some optimistic investors may also be thinking, what's going to hit us from now till year end? Alright, let's discuss a bit more in this video. As always, do watch on to find out more. Okay, last week we had a holiday shortened week, but the market didn't care and continued to rise to all-time high. With last Friday's gains, the S&P 500, Dow Jones and small cap Russell 2000 each capped off their best month in a year. On top of that, it also marked the best post-Thanksgiving Friday session for the S&P 500 since 2012. Interestingly, prior to Thanksgiving Day, the latest PCE price index showed an increase of 0.2% on the month and a 12-month inflation rate of 2.3%, higher than September's 2.1%. Though these figures came in line with expectations, they indicate that inflation remains stubborn and remains above the Federal Reserve target of 2%. With these numbers, it has been confirmed that all three inflation metrics, which are CPI, PCE and PPI, are back on the rise for the first time since February 2022. That being said, I'm not sure whether is it because of the thin and low trading volume or investors simply doesn't care about inflation now. The market continued to push higher as we all saw towards the end of last week. Some attributed the latest rally to the speculation that President-elect Donald Trump will tone down his most extreme trade policies. In addition, his pick for the Treasury Secretary, Scott Bessent, has also fueled optimism in the stock market. Reason being, this guy is a long-time Wall Street investor and has worked with some of the most renowned and legendary investors in the world, including Jim Rogers and Stanley Druckenmiller. Many believe that his appointment as the new Treasury Secretary could benefit the US economy and stock market. Alright, for the upcoming week, the calendar looks light for both economic reports and earnings front. The biggest news of the week would be November's jobs report, which will be released on 6 December, Friday. Investors will be paying close attention to this data because it comes just ahead of 2024's final FOMC meeting, scheduled to take place on 17 and 18 December. The latest jobs report could likely make the difference between a third straight interest rate cut and a pause at the Fed's meeting. While investors have largely welcomed evidence of a robust US economy, another round of strong jobs data could further scale back the expectations for Fed rate cuts and probably increase the concerns of a rising inflation. As for the earnings front, some notable names that are reporting in the week ahead are Salesforce, Lululemon, HP Enterprise and DocuSign. Personally, I will be on the lookout for Salesforce earnings and guidance as I have a small stake in them. Okay, let's move over to the technical analysis segment. Well, I don't think you need me to tell you that the broader market, aka SPY, is looking bullish as it hit and closed at record high last Friday. So what's next? Right now, SPY is hitting resistance at around 603-604 level. This is an important resistance level marked by the 61.8 Fibonacci extension level. To put it in simple terms, if we can close above this level, SPY could really fly. Above 604, the next two resistance levels are 609 and 616, which you probably can't see on the screen. Anyway, given that the RSI is approaching overbought zone, I think resistance could come in at either of those levels that I have mentioned. If we are purely looking at this coming week, personally, I think it will be tough for SPY to touch 616. Sellers may step in around 604 or 609, but I could be wrong. So let's say the market takes a little breather this week, watch for 600 as the first psychological support level, followed by 594 as the technical support level formed by the Fibonacci retracement levels. To be honest, any pullbacks will not face me until we hit 585. 585 is where the 50% Fibonacci level is. If the broader market remains bullish, this level should not be breached. So if it gets breached, then I will be standing by my shopping list, because buy might drop further towards the gap area between 576 to 583. Anywhere near this area will get me excited, as I think there will be opportunities for me to pick up shares. But given how December has been the traditionally strong month, will we get here in the next 1 month? I don't know. Nobody knows. Let's see. Moving over to Apple. Apple's chart looks pretty similar to SPY. Both look bullish and both are facing an important resistance level. Let's break down the details. First of all, 10 green candlesticks in the last 12 trading days. That obviously is bullish. However, Apple is currently sitting at a heavy resistance area around 236 to 238. It has gone near this area twice previously, and this is the third time Apple is attempting to break above it. Will third time be the charm? If Apple really breaks and closes above 238, honestly, the sky is the limit. As I have always shared, at all-time high, it's uncharted territory. You can never predict or guess accurately when will big institutions start taking profits. For me, at all-time high, I will enjoy the ride with my existing position, but I will not FOMO or chase the high. Similar to SPY, the RSI is approaching overbought zone, and if big whales start taking profits off the table, the first support level to watch could be around 233. This is a double support level formed by the first Fibonacci retracement level and the purple dotted line that I have drawn. This used to be a strong resistance level, but has now turned into a strong support level. If the upward momentum were to continue, this is one potential bounce level, because if Apple retraces till here, the RSI indicator would have cooled off a little bit, giving it more room to go up. But if 233 breaks, then we could potentially see Apple in the 220s range again. Personally, I find it quite tough to pull the trigger to add more Apple shares above 220, as the valuation looks a little rich to me. But you can do your own due diligence to see at what point, when Apple pulls back, will you be adding more shares. Okay, let's now check out Tesla's chart, which looks pretty interesting to me. So there was actually a bearish RSI divergence, which it did play out, as you can see from the chart that Tesla dropped from the peak of 362 to as low as 326. That was about $36 decline in share price. Not just that, the MACD had its first bearish cross since the last bullish cross on 24th October. To add on, Tesla was climbing on falling volume. These are all bearish signs. With this, Tesla should be bearish, right? I thought so too. Actually, the bearish thesis did play out with Tesla falling over 30 points, but somehow the bulls have been defending the share price very well. Again, on the chart, you will be able to see that Tesla has been trading above 332 support level for about 2 weeks. The bears can't seem to push the price below that level. What amazed me even more was that the gap up form on 18 November was nearly filled during intraday trading on 27 November. In other words, despite the bears pushing the share price lower in an attempt to fill the entire gap, Tesla bulls managed to close the day at the Fibonacci support level. When I say at the support level, I literally meant exactly at that level. Check out the closing price and the Fibonacci support level. Both are at 332.89. Anyway, if I were to choose a side, I think bulls have a slight upper hand now. And let me share with you what to look out for next. If Tesla can continue to stay above this 332 support level and the MACD starts curling back up, then I think Tesla could really fly. At that point, it will likely break above 362 to create a new 52-week high. From the current price of 345, and let's say it climbs to 365, that's a good $20 jump. Okay, but as usual, we have to look at things from both angles. So on the other hand, things can change or turn bearish really quickly, especially for a volatile stock like Tesla. Basically, if Tesla breaks that 332 support level, then the earlier bullish thesis could be invalidated. Honestly, if Tesla starts closing below 332 with good trading volume, then don't blink your eyes because things can happen really fast and we could see Tesla below 320 easily. Below 320, don't panic yet. To me, the key support levels that the bulls must buy hook or buy crook defend would be 300 and 285. If they break, then all hell will break loose. We will likely see a waterfall in the stock price. Specifically, 300 is one huge level to watch. If the bullish momentum is to continue, this level must hold. I repeat, this level must hold. Let's now move over to Google. Google is back to this consolidation zone between 160 and 169. It did attempt to go above 169 last week for 3 consecutive trading days, but was struggling to do so. And if we backtrack a little bit, it attempted to go lower as well. But then the 200 moving average acted as a decent support and Google bounced back up. This basically makes the analysis of Google's chart pretty straightforward. If we want to see the bullish side of Google, we need a few candles above the strong resistance level of 169. Above 169, it naturally gives Google a high probability of touching the next Fibonacci level at 174. In fact, from there, I wouldn't be surprised if the bulls keep pushing Google to the high of 170s or 180 level, something that we saw in October and November this year. On the other hand, I have shared in many of my videos that the 200 moving average has been acting as a very strong support for Google. Therefore, in terms of the downside, watch this support level like a hawk. If it gets breached, expect Google to touch 160 at least. If Google doesn't bounce from 160, it means it would have lost 2 major critical support levels, which are the 200 moving average and the 61.8 Fibonacci level. That's pretty bearish. Well, a part of me actually wishes Google drops to 160 or below. That will give me a chance to sell put options or add more shares. Let's see how the price moves and I may have to adjust my strategy accordingly. Let's now jump over to Meta. Meta has been on this short-term downtrend marked by the blue dotted channel that I have drawn. This bearish momentum started from early October this year. The positive thing is that it has not fallen below the channel yet, which means it's not that bearish, and right now it is near the top end of the channel, and unlike some other stocks that I covered, Meta still has a bit of room to go up because the RSI isn't near overbought yet. On top of that, the MACD is on the verge of having a bullish cross, but it's not confirmed yet, so watch the MACD closely this week. If we have a bullish cross and Meta punches above the downtrend channel, I think we could easily hit 590's range or even go close to 600 again. But on the other hand, if Meta gets rejected by the top channel or that 23.6 Fibonacci level, then it may start falling towards the bottom end of the channel again, like how it did for the last 2 months. In terms of support, pay very special attention to the 50% Fibonacci retracement level at around 549. Typically, if the overall trend is intact, 50% Fibonacci level is a common point for a rebound. In fact, Meta did that just recently. But if this level breaks, then I think we can easily slide towards the 530s range, with the next strong support coming in at 536. Below this 536 level, it simply spells bearish. We will talk about it if we ever get there in the near term. Alright, moving over to Microsoft. Remember I talked about this blue dotted trend line that split the chart into bullish and bearish territories? This thesis is still intact. Basically, Microsoft has been trying to go back above the trend line since early November, but somehow it couldn't do so as it spent the entire November below the line, which means Microsoft is still a little bearish. But one positive thing is that it has been creating higher lows in the process. So for us to call Microsoft bullish, it needs to continue to create more higher lows and more importantly, fill that gap and go above the blue trend line. There could be some resistance at that gap area between 429 and 431. And this is also roughly where the 23.6 Fibonacci level is. To put it simply, watch this area closely. A rejection at this area could see Microsoft falling back down again. For the downside, pay very special attention to 420. I repeat, watch this 420 level. This is the level where 4 support levels converge, which is a super rare feat. They are the 50, 100 and 200 moving averages as well as the 38.2 Fibonacci level. If this support level breaks, be very careful because Microsoft could easily visit 413. And the longer Microsoft stays below these 4 support levels, the more bearish it gets. Anyway, I somehow didn't catch this rare scene where the 3 moving averages coming together last week. So now I am contemplating if I should sell a put option here. I'm gonna give this a very serious thought now. But just to highlight, what makes me a bit hesitant now is that if the 50 moving average crosses below the 200 moving average, that's called a death cross. And just by hearing the name, you will know that it is a bearish signal. Let's see how Microsoft reacts to those levels that I've mentioned this week before I make a decision. Finally, let's have a look at Nvidia's chart. My last update was before Nvidia's earnings that took place on 20th November. Prior to that, I was saying that it's either we will see 150 or we hit 124 due to post-earnings volatility. Well, Nvidia went as high as 152.89 after its earnings. If you have put on a straddle or strangle option strategy, you might have profited from the huge movement. Anyway, can you see that green dotted uptrend line? Nvidia has fallen below it last week, but it seems like it's trying to go back and retest this trend line. If the retest is a success, meaning if Nvidia closes above the trend line, then we can say that the short-term monster run that started from August this year is still intact. Above the green trend line, I think we can expect Nvidia to hit 150's range again. On the other hand, if the retest fails and if Nvidia loses the 50 moving average support level, which sits at 135, then I think we will likely see Nvidia going back to 120's range again easily. In the 120's range, pay a bit more attention to 121 where the 50% Fibonacci level is. This is one potential level for a rebound. Personally, I won't get too excited even if Nvidia pulls back to low 120s. For me, I already have some Nvidia shares in my portfolio with a cost price of $21. So for me to add more or for me to consider averaging up, I will only consider it if Nvidia hit that 114 level or the 200 moving average. But of course, honestly, I would prefer picking up Nvidia shares below $100. I'm not sure if we will ever get that again. Well, it's the stock market, nothing is impossible, right? And oh, my plan could change along the way because things change, so I might average up at a higher price. Alright, be sure to subscribe to my channel to stay updated on this, okay? Okay, moving over to the options trading section. As I was away last week, so I have a few more trades to update this week. The first trade is this new cash secure put on Tesla which was sold on 18 November. The strike price is $270 and the contract will expire on 27 December. What happened on 18 November was that there was a report that said President-elect Donald Trump's team is looking to ease US rules for self-driving vehicles. As a result of this report, Tesla's share price gapped up at the opening, looking really bullish. Therefore, I quickly stepped in to sell a put contract, which is a slightly bullish move. However, I have to clarify that this is a pure momentum play because such news-driven rally usually doesn't last. And true enough, Tesla went sideways for the next 1 week and the gap up was almost filled. But the beauty about selling options is that even if the share price movement goes against your trade, so long as it's not that huge, you can still profit from the time decay. As you can see, my trade is currently sitting on a nice paper gain of more than 70%. If you are new to options trading and don't quite understand what I have just shared, feel free to check out the series of options videos that I have done. Okay, the second trade to update is this cash secure put on Tesla that expired on 22nd November Friday. This contract was sold on 15 October with a strike price of $190. The thought process behind this trade was that after the sell-off on 11 October where Tesla had their robo-taxi event, bears seemed to be lacking strength to push the share price down. Because for 3 consecutive trading days, Tesla has been floating above the 100 moving average support. With that, I stepped in to sell a put option. Since then, Tesla went on to trade sideways for a few more days before rocketing from 210's range to above 300, which means my 190 strike price was never close to getting breached. As a result, the contract expired worthless and my total profit for this trade is around $410 less trading fees. For more information about this trade, please check out the video linked at the top. Alright, the third and final trade to update is this cash secure put on Microsoft that expired on 22nd November as well. This contract was sold on 14 October with a strike price of 380. For this trade, I actually took a little risk because on 14 October, Microsoft looks bullish as it opened and traded above the 50 and 200 moving averages. The MACD was also on the verge of having a bullish cross, but I did not wait for further bullish confirmation and I stepped in to trade. I shared this in the same video as my earlier Tesla's trade. You can check it out if you want. Anyway, I also shared that even though I took a small risk, I have managed the risk exposure by choosing a relatively safe strike price of 380. This level is below a very strong support level, which is 385. Okay, all this said, Microsoft only went as low as 404 in the next few weeks, before bouncing up. As of 22nd November, Microsoft stayed above my 380 strike price and as a result, my total profit for this trade was the premium collected at the very start, which is 320, less the transaction fees. And if you add this amount to the earlier profit of 410, that gives me about $730 of profits in total, which is around 970 Singapore dollars. Close to 1,000 Singapore dollars of side income. I will take it anytime. Again, check out my options videos if you are interested to learn more about options trading. My videos are all free. Alright, sharing some of my thoughts to wrap up this video. First of all, I must say 2024 has been a spectacular year for the US stock market. The benchmark index S&P 500 has positive gains 9 out of 11 months this year so far. And as we head into the final month of a truly remarkable year, many investors are expecting more from the stock market. I mean, it was quite evident that the risk-on sentiment gained momentum last Friday after the Thanksgiving holiday. And I can understand why the market is so bullish ahead of December as everything seems to be going right at the moment. From a bigger picture, inflation has been trending downwards, Fed has been cutting rates, election is in the rearview mirror, and more importantly, December presents a seasonal tailwind. As you can see from this image, over the last 50 years, the S&P 500 typically gives a positive return in the month of December, offering a 73% win rate and more than 1% average return. But with all that said, as always, it's good to stay grounded and not to get too complacent, especially when the market gets greedy. As much as I remain bullish about the market all the way till the year end, I thought to just offer some contrarian views here. First of all, according to the Fear and Greed Index, the market is in the greed zone now. Watch this indicator closely. It may not be the best or most accurate indicator, but more often than not, when it enters the extreme greed zone, there tend to be some pullbacks in the market. But of course, it may not be a huge pullback, it could just be a small 2 to 3% retracement. Personally, I see such retracements as opportunities to pick up shares, something that I have done for Google and Microsoft in recent months. Another thing, as shared earlier, the recent inflation data matrix show that inflation remains stubborn. In fact, it's ticking up a little bit. With Trump taking over the president role in 2025, it's really difficult to predict the trajectory of inflation. Some say it could bring inflation back again, but nobody truly knows, so just keep that in mind for the time being. And in the very near term, watch for the upcoming jobs report on Friday. A more immediate potential risk will be a hot jobs report. If it comes in stronger than expected, the market might not like it and there could be a bit of retracement. All this being said, nothing is guaranteed or certain. The purpose of me sharing this is to keep everyone and myself in check so that we don't get caught off guard when the bigger than usual sell-off happens. I mean, do you remember the 5th August carry trade sell-off? That might have spooked a lot of investors, but I stepped in to pick up shares. So yup, I hope you get the drift. Alright, that's all for this video. Feels good to be back. Do help me with the like button if you found my content useful. Thank you very much.